Hi, we discussed D2C business model, the business aspects, why they succeeded, the key drivers. But the reality is, lot of D2C businesses have started in the last few years and have struggled to scale, and many of them have shut down. So, what is the challenge that the D2C business models face? What can we learn from them? And what can be done in future to avoid the same fate? Let's look at these aspects with some examples. Let's first learn from Mama Earth what succeeded, and then we will go into learning from failures. First, track consumer interest and changes very closely. Mama Earth built strong brand influencer relationships. It was the first mover in white space. Millennials are invested in brands that oppose their values. So you can create a lot of brand stickiness if you are able to relate to millennials. And millennials will pay the premium for causes they believe in. In the case of Mama Earth, it was cruelty free, eco friendly, sustainable brand as compared to typical multinational big company with chemicals in their products. Two, the power of being internet first is very, very useful. Don't worry about offline, online, omni channel, multi channel, etc. Start online, own website first. Then go to horizontal marketplaces Amazon, Flipkart, Nykaa, all of that. Offline exclusive stores, offline shop in shop, all of them will follow. But start online, start with your store. That's a learning. Third, diversify and differentiate. You cannot be one product or category winner. Have to use it as a beachhead. Start with one product, one category. Win there. Create the brand connect. Start off. But after that, for scale, for diversification, differentiate, create sub brands, and create product innovation. One of the biggest challenges of D2C business is D2C, will it ever scale? Can one product category which addresses a pain point, a white space, unaddressed market, all of it is great. But is it large enough? Can it scale large enough to become a large company? It cannot. So you have to add on more adjacent products after your beachhead succeeds. Focus on unit economics. Outsource whatever you can. Keep the organization nimble so that you are able to make a margin. Pricing cannot change easily. So you cannot afford to lose initially because of negative unit economics or loss-making unit economics and hope that later in the day you will be able to increase price. That just is not possible. Let's look at US context. We talked about some of the successes. There have been a lot of successes, but there have also been huge challenges and struggles, both for small players and giant players. Let's look at the US context now. Warby Parker, stylish, affordable eyewear. 5 years it took for them to become a $1.2 billion company in terms of valuation. Then it became $5 billion valuation. Then it went for an IPO. Bonobos, another example. Urban menswear company was acquired for $310 million by Walmart. Great success story. Bonobos, Urban Menswear, Walmart acquisition for $310 million. Allbirds was a company that is into sustainable sneakers. Again, a D2C brand. People all want sneakers. It's a large category. Sustainable is a very good story and brand connect. They IPO'd during the pandemic. These are the successes. But there were huge challenges and struggles, both for small and giant players. Warby Parker still is not profitable. Bonobos, under Walmart, still losing money and had to do layoffs. And Walmart then sold off ModCloth, Bare Necessities, and Shoes.com after struggling. So large companies having D2C brands, acquiring it, selling off, and struggling. Allbirds, much higher losses now. 75% year on year increase in loss despite their IPO. So you have examples of companies which succeeded but struggled in the D2C space. So what are the learnings? Figure out how to turn profitable before scaling or lavish spending on customer acquisition is one learning. You cannot use risk capital, venture capital funds to fuel marketing and scale, hoping that one day you will turn profitable. 2. Single products category as a loss leader and then sell high margin other products can be a very risky proposition. Casper Mattress, sleep company, not a mattress company. That's how they positioned themselves. IPO'd was done at half the previous round valuation by Casper because they were a single product, no adjacent product to talk about, just mattress. Now, look at it. How many times do you replace your mattress? Mattress replacement cycle is nearly once in 10 years. Repeat sales are few. You may argue that for a guest bedroom, you may add a guest bedroom in your house and then you need a mattress. But guest bedroom additions are very rare. And even if it were to happen, happens within the first year. It is not a repetition. So here is a single product company without a repeat purchase potential because mattress is a 10-year horizon product. So they also suffered from high cost of acquisition. Very steep R&D cost to make a better mattress. Now you can afford R&D costs of a high level if there is going to be repeat purchases. But cost of acquiring customers high, R&D costs were high, low lifetime value because there is no repeat purchase. Competition from other startups and also Amazon, Walmart, which already have customers coming in, they have organic traffic, and if they are coming to Amazon or Walmart, they may as well buy a mattress there. So in that situation, how will Casper make money? And a long replacement cycle. So all of this meant Casper lost a lot of money. In April 2020, they shut the European operations, laid off 21% of the staff. And after all the IPO and the success and all of that, in November 2021, they were taken private. So that's a learning. Don't wait for profitability. Another learning, hedge bets when consumer demand is in flux. When consumer demand peaks, think, is it a blip or is it real peak in consumer demand? Let's take an example of Peloton. It was founded in 2012. 2019 they IPO'd. Revenues doubled and doubled again because of pandemic. People could not go out. They could not go to the gym. Therefore, they wanted to get an exercise machine, which is what Peloton makes. Very famous, leader in that. And during the pandemic, revenue doubled and doubled again. So 4x increase in the revenue. By November 2021, when the pandemic started waning down, the gyms bounced back to pre-pandemic levels. What happened to Peloton? They lost $40 billion in valuation in market cap. 2022 had to restructure. So what do we learn from here? Problem of growth, miscalculated demand and supply. Expanded the production, acquired companies, opened a new factory, but supply chain was challenges because of pandemic. They could not get supply chain. Pandemic pulled forward the demand because people could not go out due to lockdown to the gym. It pulled forward the demand, but did not expand the audience size. After the pandemic went away, those people had the machines. The number of people buying machines did not expand. Those were serious learnings. They, of course, had several other unrelated issues. There was a data leak, there was a product recall due to safety. There was a media perception scare that got created because there was a TV show that showed a person dying using a Peloton bike. Okay. It's a show called Just Like That. And when that show came on, at that time, the share prices fell by 11%. It had nothing to do with Peloton. It was a fictional show because it showed that. So that is the power of brand and D2C and perception, what it can do. That's another learning from failure. Don't abandon core value proposition while expanding and scaling is another learning. There is a personal connection, differentiated value proposition in D2C. That core value proposition has to be maintained. If you ignore that, the D2C business can be in trouble. Let's take an example of this, again international example. There is a direct-to-consumer razor brand called Harry's. Harry's competed and took on Gillette and other majors in razors head-on. What was their D2C value proposition or the niche they identified? Harry said no over-design. Simple, high-quality, premium razor. Sold through barber shops and their own stores. Just 2 types of razors. No multiple SKUs, no 6 blade, 5 blade, 8 blade, 10 blade, nothing. No other grooming products. Profitable, 10-year-old company, Harris, with just 2 types of razors. Dollar Shave Club launched through a viral video. Simplicity, no nonsense razor on a subscription basis. Dollar Shave Club said, you shave every day or every week or every 2 days at $1 per month plus $2 for shipping, $3 per month. We will send you razor every month. So Dollar Shave Club was a direct D2C company in the razor space. Gained fame in 2012 when they made a humorous video that mocked the complexity of razor choices for men. So they had a lovely video where the co-founder and CEO, Michael Domin, came on the video and said, do you think your razor needs a vibrating handle, a flashlight, a back scratcher, and 10 blades? Your handsome ass grandfather had just 1 blade and he did very well. So that became viral. It captured people's attention. You don't need so much complexity in a razor. Multiple blades, vibrating handle, and all of that stuff. So they went on to capture 10% of the US razor blade market. Gillette had 60% market. 2015 revenue of Dollar Shave Club was $152 million. In 2016, it was acquired by Unilever, the FMCG giant, for $1 billion. A D2C razor company with a subscription business model. Look at all the new age business models we have covered. Subscription and D2C. Unilever acquired it, launched premium products. Initial success was thrifty buyers and simplicity. Earlier it was a low customer basket size, simple razor, just 2 SKUs. What did Unilever do? They did a complete U-turn. In 2018, they launched a wide range, 3 dozen products, 6 categories, fragrance, oral care, 4 and 6 blade razor, and prices went up from $1 up to $10 per month. Now, customer segment did not adapt to it. Higher end premium products are for the value conscious customer, does not work. They also wanted to do stores like Harry's did, but Harry was a premium. So it's tough. Gillette also launched its own subscription service to compete with Unilever and Dollar Shave Club. For Gillette, it was easy. They were already in the razor business. So the whole acquisition of Dollar Shave Club, getting into higher premium products, increasing the complexity, proved to be the downfall. Dollar Shave Club remains a great brand with excellent product offering, and we are fully committed to stepping up its growth. So these are learnings from extremely tough D2C business model that we should learn from.